Read. Now, Yes Bank had reported numbers. It was a weak quarter for Yes Bank as their asset quality deteriorated. Their net interest margin is, though, the best in 9 quarters versus expectations of a decline, which had been there earlier. Bank's return ratios are poor in the fourth quarter, while it has also lost market share for the year. Prashant Kumar is Managing Director and CEO at Yes Bank, and he's joining us right now to take some questions and discuss the numbers with us. Mr. Kumar, good to have you with us here. Thank you very much for your time. Can we start with the asset quality question, sir? What happened in the quarter gone by? What is the outlook at this point in time? What should we build in really in F524?
So basically on the asset quality, if you see our slippages are 25% lower as compared to the last quarter. And the gross NPA, which used to be in the range of 14-15%, currently is 2.2%. But sequentially, yes, it has moved from 2% to 2.2%. And fundamentally because of technical things, there were certain accounts which were under the COVID restructuring, and they are performing assets. But as per the Kamath Committee regulations, if those entities do not meet the financial ratios as on a particular date, like 30th September 22, they have to be technically downgraded to NPAs. So I think that was the only thing. Otherwise, we have been able to protect our asset quality. And if you see the net NPA has come down to below 1%. It's a 0.8%. And I think if we see the history of Yes Bank, this is one of the best. And even in terms of net assets as well as net carrying value of security receipt, has come down from 4.8% as on March 22 to 2.4%.
All right. Hi, Mr. Kumar. Good morning. So you expect asset quality to get better from here, right? That's a sum and substance.
Absolutely. Because in the FY24, the slippages would be somewhere between 1 to 1.5%.
Got it. All right. Let's move on then. Your loan growth, you're guiding for around 15 to around 20%. Retail as a percentage of your book has gone up. In the last few years, going by your presentation itself, in the mid-20s, it's gone to mid-30s. Now it's at the mid-40s. So you're expecting that vertical clearly to outgrow what the overall business will grow at. Where do you see this number stabilizing in terms of retail contribution? And more importantly, if you could tell us, Mr. Kumar, what about the NIMs? From around this 2.8%, which is looking quite good, the street is working with it skimming down a little bit. To what levels?
No, in terms of retail contribution to our loan asset, already like 45%, but retail is growing much faster than the corporate. So even the last year growth has been 38%. I think this trajectory would continue for some time, and retail would be somewhere around 50% of our balance sheet. Regarding the NIMs, I think we are still in that trajectory where for us this is not peaking out. This would be a continuous upward journey for us. And the real contribution is coming not only from better yield on the loans, but also in terms of our deposit costs. If you see like the average CASA deposit has grown by 26% last year, and the average current account has grown by 30%. Today, like our CASA ratio is 31%, and the 50% contribution is coming from current account alone. I think this trajectory would continue to improve, and we would be seeing a upward improvement in our NIMs.
What level, sir? Could you give us a number?
Sorry, can you again say?
Could you give us a number? You're expecting NIMs to improve. To what levels? Give us a broad range.
No, number I would not be saying, because the reason is you need to be cognizant about what is happening in the market in terms of interest rate scenario. But I think the way it is inching up, it would continue to have this upward trajectory going forward.
Okay. Upward trajectory going forward. I think, what the street is really disappointed with, Mr. Prashant, is that you're losing market share in the loan space as well. Now it's at about less than 1.5%, and this at a time when there is so much competition, not just from traditional banks, but from fintech companies, etc. Wanted to understand, is there more market share loss that one can expect, or do you think there is an improvement over there? And also, on your cost to income ratio, it's one of the worst in the industry right now. Can you explain to us at a time when, private sector banks are seeing a big up move, yours really there's a lot left to be desired in terms of these internals. Any recovery that we can expect?
No, if you see in terms of our market share on the loans, and if you compare with the previous years in terms of 2020-21, every year there has been a improvement in our market share on the loans. Overall, if you see, it's almost 13% loan growth, but retail is growing 38%, MSME around 22%, mid-market is also growing 36%. So it was a very strategic call to reduce our large loan part, which has already peaked out, I would be saying. And next year, 15 to 20% growth would further improve our market share. So I'm not saying our market share has come down, it has actually gone up. Okay? In terms of cost to income ratio, I think what we need to also appreciate, this was like a strategic shift in the bank last 3 years. We are making it more granular, more retailization of the bank. And whenever you go into this journey, there is always a higher cost. But even with this granular retailization of balance sheet, we have been able to protect our PPOP2 assets. And now there is a time where we have reached to that inflection point where the cost to income ratio would also start improving and would giving us the higher NII and also to have a control on the cost.
Well, Mr. Kumar, we've got your operational performance. Is there any additional provisions that need to be made because of the pending A1 matter in courts? Is there any pending provision or it's all been done?
No, so not required. So to be very frank, I think the write down of 81 has been done strictly in accordance with the regulation and Basel regulation. Okay. And now, since the matter is now pending with the Honorable Supreme Court, so we'll take a call after that is decided.
So as of now, no additional provision needs to be made on the back of that front.
Right.
Yeah. Okay, got it. With regard to your shareholding as well, you had a couple of the large shareholders, banking names, who have stake in the shareholding, and that cooling off period expired a month or so ago. Anything you've heard from them? Because that's what's causing the stock market to be a little bit jittery. Will there be some large supply that will come in there? Anything you have picked up from the buying or from the selling side?
No, if you see the movement, we analyze it every day. So I think after the lock-in on 13th March was over, so all our large investors have not sold a single share. That gives us quite confidence to us. Yeah.
But are they looking to sell? Have you heard anything?
No, we have not heard anything. They would be in the best position to respond to that. But we have not heard.
Have they communicated that they don't want to sell in the near future, at least, Mr. Kumar? I ask you this because besides the operational performance, all the other metrics that we discussed, but this is a bit of an overhang. So any communication from them or no communication whatsoever as of now?
No communication. But if you see like what happened in, say, more than 1 month, so actually there has not been anything.
All right, Mr. Kumar, thank you very much for your time. Good speaking with you. Appreciate you joining in with all of that. Good luck to you, sir, and the business. And we hope to speak with you soon again.